It's 2 inches the morning. You're lying in bed, phone face down on the nightstand. You close your eyes. 5 minutes later, you pick it up, not to scroll, not to check texts. You open your banking app, you look at the number, it hasn't changed, you put the phone down. 30 minutes later, you do it again. If that sounds familiar, you are not alone. And if you think that's just you being responsible with money, I need you to stop right there. Because what's actually happening in that moment has almost nothing to do with financial discipline. And today, we're going to talk about what it actually means and what it's quietly costing you. My name is Nico, and today we're going to pull back the curtain on one of the most misunderstood money behaviors out there, the hidden psychology behind why you keep checking your bank account. Not once or twice a day, constantly, compulsively, like somehow the number is going to be different than it was 20 minutes ago. If this video hits close to home, hit that thumbs up. It tells me to keep making content like this. And if you want more honest, real talk breakdowns about how your brain and your money actually interact, go ahead and subscribe. Now let's get into it. Here's something that might surprise you. According to a survey by Empower, the average American checks their bank account around 5 to 6 times per week, but that's the average. For a significant portion of people, particularly millennials, that number is closer to daily, sometimes multiple times a day. And a Bankrate study found that roughly 57% of Americans report experiencing some level of financial anxiety on a regular basis, not occasionally, regularly. The American Psychological Association has ranked money as the #1 source of stress for Americans for years running. Not health, not relationships, money. Now, here's the part that doesn't get talked about enough. Most people assume that checking their account constantly is a sign that they're on top of their finances. Like, I'm watching closely, I know what's in there, I'm being responsible. But the research says something completely different. Behavioral finance researchers and financial therapists have actually identified a pattern called financial hypervigilance, and it's essentially your nervous system treating your bank account like a threat that needs constant monitoring, the same way our ancestors scanned the horizon for predators. And here's where it gets really interesting. The checking itself does not reduce the anxiety. It only provides temporary relief. A few minutes of calm, then the tension comes right back. And eventually, you check again. It's a loop, not a strategy. Let me tell you about Marcus. Marcus is 31. He makes $72,000 a year, solid income, stable job in project management. On paper, Marcus is doing okay. Rent is covered, car payment handled, goes out on weekends, keeps up with everything. But Marcus has this habit. Every single morning, before he even brushes his teeth, he opens his banking app. He checks his checking account, then his savings, then his credit card balance. He does it again at lunch, again before bed. Sometimes at random moments during the day when a thought crosses his mind and the uncertainty becomes too uncomfortable to sit with. And if you ask Marcus why he does this, he'd probably tell you he just wants to stay on top of things. But here's the truth, and I say this with zero judgment. Marcus is not checking because he has a plan. Marcus is checking because the uncertainty of not knowing feels worse than the anxiety of seeing the number. It's a control mechanism, not a financial system. Now meet Jordan. Jordan also makes around $70,000. Same age, similar lifestyle. Jordan checks his accounts maybe twice a week, Monday morning and Friday afternoon. That's it. And Jordan doesn't do this because he's less responsible than Marcus. He does it because he built a system. Automatic transfers to savings and investments on the 1st and 15th of every month. A rough budget he revisits once a month. A few clear rules. And because a plan is in place, there's nothing uncertain enough to obsessively monitor. The anxiety that drives Marcus crazy simply doesn't have the same grip on Jordan. Same income, same age, completely different financial experience. And here's the part that will blow your mind. Marcus's compulsive checking is not just stressful. It is actively costing him real money. Let me show you the math. Because financial anxiety doesn't just stress you out. It changes your behavior in ways that are well documented in behavioral psychology research. People operating under chronic financial stress, which is exactly what unresolved money anxiety creates, are measurably more likely to make impulse purchases as a form of emotional regulation. They stress order food delivery. They make small, unnecessary purchases that provide a brief dopamine spike and a temporary sense of normalcy. They avoid looking at their full debt picture because it's too painful. They delay investing decisions because doing anything financial when you already feel fragile feels like gambling. And that's the crazy part. The anxiety about money is actually causing them to lose money. For Marcus, This behavior adds up to roughly $350 a month, not in one big obvious splurge. In the slow accumulation of convenience spending, impulse buys, and small emotional purchases that made a hard week feel slightly more manageable. $350 a month invested at a 9% average annual return, which is in line with the historical average of a broad market index fund over 30 years, becomes approximately $640,000. Over 35 years, it's over $1 million. The math is brutal, not because Marcus made one catastrophic mistake, but because anxiety he never addressed quietly steered hundreds of thousands of dollars away from his future, one small emotional purchase at a time, for decades. So, where does this anxiety actually come from? Because it almost never starts with the bank account. For most people, in their late 20s and 30s, financial anxiety is rooted in a few specific places. The first is what behavioral economists call a scarcity mindset, a mental operating mode, where your brain is constantly focused on what you don't have, what could run out, and what might go wrong. Once this mode gets activated, and it can be triggered by as little as one difficult financial period, 1 month where things got tight, one job scare, it can become your default financial operating system. Even when things genuinely improve, the vigilance stays, because your brain learned that money is unsafe, and it's not going to forget that lesson just because your paycheck went up. The second driver is comparison. And in the current environment, comparison is relentless and weaponized. You open Instagram and your college roommate just posted photos of their new house. LinkedIn shows you someone your exact age who just made director. You're surrounded by visible signals of financial progress that your brain, which evolved to benchmark your survival against your immediate social group, interprets as evidence that you're behind. So, you check your account, not to make a decision, but to reassure yourself that you're still okay. Except the number doesn't actually answer that question, so the relief lasts about 4 minutes. The third factor is the education that never happened. Most people, and I genuinely mean most people, were never taught how money and psychology interact. They might have learned basic math, maybe a lesson on budgeting in a class they've long forgotten. But nobody sat them down and explained that anxiety drives impulse spending, that a scarcity mindset actively sabotages long-term investing, or that the uncomfortable feeling they're trying to manage by checking their balance is a psychological pattern that needs to be addressed at the root, not managed through more monitoring. Now, I know what some of you are thinking. Isn't it better to know your balance than to ignore it completely? Absolutely. Awareness isn't the problem. Checking your account once or twice a day with intention reviewing a transaction, confirming a transfer went through, that's called being responsible. There's nothing wrong with that. But there is a meaningful difference between intentional monitoring and compulsive checking. One is a strategy, the other is a coping mechanism. And the reason this distinction matters so much is that compulsive checking creates the illusion of control without actually providing any. You look at the number, you feel a brief moment of relief or a spike of stress, and then nothing changes. No decision is made. No action is taken. The underlying anxiety is untouched. You just checked. Here's where it gets really interesting, because the cost of financial anxiety isn't only in the stress spending. It's also in the decisions that never get made. Every month you spend locked in anxious monitoring mode is a month you didn't spend building the system that would make constant monitoring unnecessary. It's a year where you delayed increasing your 401k contribution because financial fragility made risk feel unbearable. It's 3 years where you kept meaning to open a Roth IRA, but the discomfort of sitting down and doing it never quite got low enough to take action. And that delay has a real price. If someone starts investing $300 a month at 27, at that same 9% return, by 62, they have approximately $882,000. If they wait until 32, just 5 years later, that number drops to around $549,000. That 5-year delay cost them over $330,000. Not because they were reckless, not because they made bad investments, because anxiety made later always feel safer than now. And later is the most expensive word in personal finance. The number in your bank account is not the thing that will make you financially free. The habits, the systems, and the emotional relationship you have around that number, that is what determines everything else. And the compulsive monitoring is not the disease. It's a symptom of something that needs a real solution. So here's what actually changes things. You don't just check less, you build more. You build a system clear and automated enough that obsessive monitoring becomes genuinely unnecessary. Automatic transfers on payday, even if they start small. A scheduled account review Monday and Friday, like Jordan, instead of checking every time the anxiety spikes. You start addressing the scarcity mindset directly, not by ignoring your finances, but by creating enough structure that uncertainty stops running the show. Because here's the shift that actually matters. You stop being the person who monitors their account out of fear, and you start being the person who has a plan that runs whether they're watching or not. That is not a budget tip. That is a fundamental change in how money feels in your daily life. Marcus and Jordan had the same income, but Jordan's money was working while he slept. Marcus's money was just being watched. And the only real difference was a system, and the decision to stop letting anxiety steer every financial choice. The people who build real wealth aren't always the highest earners. They're the ones who removed anxiety from the equation early enough to let time and compound interest do the heavy lifting for decades. And that starts not with a better spreadsheet, but with an honest look at what the checking is really about. If this video helped you see your own money behavior a little differently, hit that thumbs up. It genuinely helps this channel reach people who need to hear this stuff. Subscribe if you're new, because this is exactly the kind of content we make the behavioral side of personal finance, the math behind the decisions, the psychology that nobody talks about. Drop a comment below. How many times a day do you actually check your bank account? I'm genuinely curious. And as always, I'll see you in the next one.